Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, May 23rd, 2018, aka Video Wednesday. I don't can't recall the last time I did 3 videos in one day, and I don't think I've ever done any more than that. And again, the reason I'm doing that is I just see it. There's a lot in the charts that stand out to me right now. Trading as well as investing is all about being patient and waiting for those times that the market is conducive or setting up, or a particular stock index security is setting up for a swing or trend trading op, and the rest of the time you want to sit out. I equate trading to, I love Animal Planet, all those nature shows, and you'll watch the cheetah or the lion hunting in the savannas in Africa, and they don't sit there and run after every gazelle that walks by. No, they sit patiently. They wait for the right one, injured, weak, or one to get close enough to them, and then they pounce on it. If they run after everything that's out there, they'll starve to death. They'll burn up all their energy. Trading's the same way. You have to sit back, wait patiently for your setup. And I'm seeing a lot in the charts right now that show us we have some potential trading ops, swing trading, even trend trading ops here, and that's why I'm taking the time to do these videos. So in this video, we'll start out with the outlook for crude oil. We'll roll into a few commodities that stand out. I'm not going to cover them all, just the ones that stand out. Some are official trade ideas, some unofficial trade ideas, some are even recent trade ideas. And then time permitting, I'd like to cover bonds too. I think bonds are an opportunity right now. And then maybe some individual stocks if there's time left. Okay, I covered this chart in the last video, but in case you didn't watch that video, I just wanted to point out before we roll into analysis on crude oil, I spent the last video I did extensive analysis on the US dollar, the euro, the yen, which are currencies that impact the dollar to the largest extent. And so I made the case for a correction in the dollar in that video. And what I'm going to show you here, which I showed in that video, is just the how tight historically, not recently, but historically, how tight the inverse correlation is between the US dollar and oil. What I mean, there's two types of correlations. Positive, which means one thing goes up, something else goes up along with it, and they move in lockstep. Inverse correlation means one goes up, the other goes down. So what I've done to make this chart a little easier to see that correlation is I flipped the dollar upside down by using UDN instead of UUP. UDN is the bearish dollar ETF, so it's the inverse. Dollar goes up a percent, UDN goes down a percent. And that shows you then it takes an inverse correlation, turns it into a positive correlation. And this goes back to 2012, and you can see, and as I talked about in that last video, don't pay attention, to the differentials in price, because crude oil and the dollar don't move up in lockstep percentage wise. In fact, crude goes up a lot more. If crude's rallying, it can go up 40, 50% or more in an uptrend, whereas the dollar is rarely going to do that. So the dollar moves a lot less every day in percentage terms because currencies aren't nearly as volatile as crude oil. So therefore, what you look for are the trends. Is one's going up, is the other one going down, is the other going down, and vice versa. And so you can see that with of course, the long-term trend's unmistakable, but even you get in, you look at these little rips and dips, and you'll see it's a very tight correlation, but there are periods of what I call temporary disconnects, and we're having one right now. In fact, this is one of the largest disconnects that we've seen. These two lines should be moving together, but you can see the dollar UDN has been falling, meaning the dollar's been rallying since the beginning of the year while crude oil's rallied. That is unusually rare. Again, you can look at this chart, but it's not unseen. As I often mention, there are those periods of disconnects where sometimes you get not so much there. But right here, you can see both rallying, or, the dollar correcting, UDN going up, crude rallying as well. But then you got a mean reversion. You can see that the dollar rallied, that came back down. But for the most part, like I said, they tend to move in lockstep. So this won't continue forever. I have some mixed thoughts because I am bullish on the dollar right now. I'm sorry, let me make that clear. I'm bearish on the dollar intermediate term. I'm not talking today, tomorrow, maybe, but over the next few weeks, even the next few months, I expect a correction in the dollar. However, I'm also bearish on crude, so it's possible that disconnect continues for a while, or it's possible I'm wrong. Maybe the dollar does rally, I'm a little stronger on my convictions for a rally in the dollar than I am on my convictions for a correction in crude. Although again, my expectation is for both. Maybe crude just trades sideways for a while and the dollar corrects. That would be a reversion to the mean as well. All right, so you don't have to have, the dollar correct and then crude, crude can do whatever it wants, but that's my outlook. I'm probably making that more confusing than I need to. Let's just jump into the charts, look at USO. You know what? Before we look at USO, let's just look at crude futures because that paints a better picture of crude price. Okay, this is a 60-minute chart of CL, crude futures. And what it shows is what I believe to be a very well-defined trend line here off the early April lows. Crude's a volatile, very volatile commodity. So you're going to see these. It's not unusual to see these little brief intraday, the wicks, these candlestick tails, these shadows right here coming down through that trend line. But there's a lot of reactions on the trend line, so I give it a lot of validity. I think it's a very important trend line. A lot of reactions, 4, 5, 6, 7, and finally we broke down. Now I've been pointing out divergent highs for a while, and I'll say this, this uptrend in crude has been surprisingly, unusually resilient. We had a divergent high right here, and it's not as if it didn't play out for a correction. We had a divergent high right here as well, and each of those played out for little corrections, but they were small pullbacks within a larger uptrend. What's different this time around? Well, number one, those divergences have only continued to grow. They've continued to build. So we've had negative divergence all the way from back here. Finally, we had a breakdown. Let me zoom in a little bit so you can see this chart a little bit better here and what's happened most recently. As I zoom in, you can see we finally broke that trend line, a well-defined trend line, which culminated in a bearish rising wedge pattern. We kicked back tested it from below with a big impulsive red candle so far. And again, CL, I like CL because the futures trade around the clock, virtually around the clock, and it paints a much better picture. This is where the pros are trading. The pros are, for the most part, aren't trading USO. They're trading crude futures, the institutions, everything else. So there it is. Boom. Look at that big red candle. That's bearish. The fact we broke down, failed on the back test, there's no other way to spin that, in my opinion. I may be wrong, but it appears to me that this is, finally we've seen what looks like at least a near-term top in crude. Targets down here, 66, about what is that, 69, 66 or so. There's a target there at 70.50. And I think right now at most this would be, let's say, my maximum target. And again, the charts are dynamic, and so is my analysis. It could be more than this, but at most at this point, I'm looking for a pullback to 67.24, and my minimum targets are right here. This is my preferred target at this time right now. I have a CL short that I'll most likely cover there, but it depends how everything's looking, how the dollar's looking, how the charts of crude are looking, and everything else. So there's crude. Oh, look at USO for you ETF traders, prefer ETFs, well-defined uptrend line right there. And we're still well above that trend line. We have a divergent high right here. You can see negative divergence on the PPO, down on the RSI. So by all accounts, this looks bearish to me. And, one target, well, you can see all the lines that I have. Those are all potential target. Forget about this. That's an old trade that was stopped out. Those target levels, we were stopped out on the last crude trade. But this is where I see us going. Probably come back in, and we haven't visited this trend line in a while. So there's my target. That trend line and/or the 1327-ish, call it, about 1330-ish level. That's where I think crude is going minimum on before all is said and done on this pullback. Where is that going to be from? Let's see, from where we were at the highs. That's a drop of about 9 to 10% or so off the highs. So I think there's more downside in crude, even if it's just a correction within this larger uptrend with another move higher. If we go much higher, we'll take out this divergence. Now, I made mention on the site under the post, the last update I did before the close was IWM when it broke down from that 60-minute rising wedge. Under the comments section, and I do encourage you, if you get those emails, if you're a member of the site, you get an email every time a front page post is made. If it's something that you're interested in, you should check the site. I plan to in the future if you have the ability to receive an email notification when a comment is made under a front page post. As of now, there's not. And what I'm getting at is I posted several updates under the comment section under that post, including two significant developments in the energy stocks yesterday. I mentioned that we had a bearish engulfing candle on IWM, and that we also had a bearish engulfing candlestick on XLE. This is XLE, a daily chart. I'm zooming in so you can see this bearish engulfing candle. That means that body of this candle engulfed the previous day's candle. That's bearish, and so far we're falling through to the downside. That's what I want to see. That's what I need to see to confirm a bearish engulfing candlestick. It's a likely topping stick. So if we close the day red today, especially another red close, that is a high probability candlestick topping pattern, a bearish engulfing candle followed by additional downside. That's XLE. XLE also, and remember, this is the most widely held energy sector ETF. I mentioned this the other day. This is a triple top high. We had a high right here. Sorry, I missed that with the wrong drawing tool. High right here, all around the 78.50-ish level. And what's interesting here, and what I like even more for the bearish case is we took that level out. We punched up above it, which is actually very bearish because that's a failed breakout, a bull trap. I don't chase overbought divergent highs, and some people will. They buy breakouts to new highs because it's bullish, and so far that's a failure at a triple top high with a big bearish engulfing candle, bull trap, you name it. All the check boxes are checked. Keep in mind when you trade XLE, you're pretty much just trading Chevron, ExxonMobil, and Chevron Texaco, XOM, and CVX. Actually, I think they dropped the Texaco name a couple years back after they bought them. So Exxon, I put this up before, XOM and CVX, and I'm going from memory. I think they make up over 40 or around 40% of XLE. So you're concentrated there. You're not as diversified. And these are large cap stocks. You want more bang for your buck. If you get the call right, you go with XOP. I equate XOP akin to when you're bearish or bullish on oil. If you go with XOP, it's like trading GDX in lieu of GLD. If gold goes up 20% or down 20%, the gold mining stocks will go up 30 or 40 or more, or down 30 or 40 or more. They're almost like a leverage play on gold. Same with XOP when you're trading crude oil, because these are smaller caps. First of all, XOP is much more diversified. It's not concentrated in just two or a handful of stocks like XLE. And these are smaller companies. They're not mega cap stocks, so they tend to move more up and down when crude goes up or down. And as I mentioned yesterday, big bearish engulfing candle right there. You can see it so far follow through today, down about another 1.7%. And it looks to me like XOP is going lower. Drip, story of my life this year. Some of these stops, this is part of trading. You just have to use stops that are, that's where I thought was a logical stop. They took us out day before yesterday, went down a little bit, and then reversed. But as I mentioned in the update, I still very much like this. This setup looks good. This is a bullish falling wedge pattern. It's broken out now. I just made the case on the daily chart for a potentially significant top. There's the breakout. It's impulsive, close to the first target so far. There's that second target, potential third target, positive divergence on drip. Remember, drip is just XOP upside down. This is the 3-time leveraged oil and gas E&P ETF. It's the bearish one. And so, it's Gush is its counterpart, the bullish one, and you'd see a bearish rising wedge in Gush or XOP. All right, moving on. Let's roll into commodities real quick. I'll show you a few that stand out. JJOFF. This is an active trade right now. I think it still looks good. We had this bullish falling wedge right here, divergent low at the lows. We had an initial thrust up, a perfect back test of the wedge, and it started to move up. It's down a little bit today. As long as, I'll stick with the stop. They clip us out, we can always go back in. And again, as I always say, these are just suggested stops. If you like the longer term chart, your longer term trader, you want to give it room, give it some room. Let it go between under those lows. And it also depends where you bought it. Maybe you didn't take the initial trade. Maybe you waited for a back test of that wedge. Maybe you buy it today on this pullback. Either way, it appears to be bottoming, and I like coffee. So that's JJOFF. I've mentioned quite a bit lately. I'm bullish on sugar. That's not the one I wanted. SGGBF, I think. No, that's not working. Let's find it here for you. There's a couple different sugar ETFs. Here it is, SGGFF. Big divergent low. Again, I've mentioned that recently. Nice clean downtrend line breakout, and it's been moving up impulsively so far, up about 8.5 or so percent, 9% actually since that breakout, almost 10% actually. And it's just looks good. Sooner or later it'll have a counter trend pull back, but there are times I've seen these ETFs go, these commodity ETNs, I should say, and the buying is just impulsive. I've seen it in coffee. I've seen it in most of these commodities. It can happen. So don't count on a pullback. If you get it, great, as long as the charts look constructive, which I still believe they do. The other option you can trade is Kane. This was an official trade idea. We got stopped out here, and that one went quite a bit lower. So this wasn't just a brief stop rate or a slight stop clip. This one stopped, and that's what stops do. They protect you. But I followed up, and I mentioned there was this downtrend line, divergent low. Um, Maybe we come in back test it, maybe not. That level's not really very. Actually, it is. It's a little bit. There's some reactions there. So around $8, we have some resistance, but the chart's constructive, and over time we may continue on up and hit all these targets. And again, my longer-term outlook on a lot of these commodities, particularly the ag commodities, is bullish. Let's see, wood. I had a price alert on wood today when I was doing one of the videos. I've been consistently bearish, warning of a top of actually of a major top in lumber prices, LB or lumber futures, and they've been crashing lately after a vertical run, a parabolic, a blow off top. If you look at the chart of lumber futures, and wood, I mentioned, is not a direct play on lumber prices. You can only trade, a direct play on lumber is LB, lumber futures, random length lumber. Wood and cut are two ETFs that hold companies, stocks that are in the timber and forestry industry. Now, however, I've showed a chart in the past, like I showed you in the beginning of this video with the dollar and oil. I've showed a chart of both of wood compared to lumber over a long period of time, and you can see the correlation is unmistakable. So they don't move in lockstep, but they do. The trends are the same. If lumber prices start to continue or do continue lower and have peaked, then there's more downside in wood. So I may add this one as an official trade. So what I'm looking at here, this bearish rising wedge, these two white lines, you can see we broke down below it today, and where I think this one's headed. And again, if you're already in it, great. Or if you want to take it, whether I add it as an official trade or not, I see a lot of support here. I see a support zone. You can see the labels there, the values. I see a long-term uptrend line that even goes to the left of this chart. So I figure when we hit that, especially if it's a pretty much of a straight shot down, we'll get a reaction there, and then ultimately probably go on to break that trend line. I see a lot of potential in this one. Just if you're wondering, I don't believe there are any inverse lumber or timber ETFs out there. You just have to short this, so you'd have to have a margin account. Otherwise, I don't see how you can benefit from a drop in lumber or wood prices. If anybody knows otherwise, let me know. All right, NIB. This was a recent trade idea. That was another one, story of our life. They clipped our stop by a hair just one day, went on to play out exactly as expected, went on to hit the first target. There's support right there. Now, this one's looking interesting. Somebody asked me about it the other day, and I mentioned it's tough because it could continue down. There is this divergence. I'm on a 60-minute chart now. If I didn't mention that, just flipped from a daily to a 60. Nice support right here. You can see this line right here, about 31.38. Bullish divergence as well. And we can look at futures. Let me do that. Here it is. This is CC, a symbol for cocoa futures. It's a 60-minute chart. Nice, clean. Look at that bullish falling wedge. Look at those divergences starting to be confirmed here at support. You can see some reactions back here. So I'm really warming up to that, at least for a bounce. I think a top is probably in for a while. So I'm not looking for a long-term trade, but maybe, a long here at support. I'd favor that versus a breakout of the wedge. I think the wedge will break out, and I think would pop probably up here. I'd say this would be a good target. Let me adjust that line for you right here. I'll put that one back later to 27.44, somewhere around there. And to quantify it for you, that would be a move of about 5.25% or so, at least 5% in CC. And again, go back to that other chart we were on. There is some support on another support level below an NIB. NIB is the ETN for it, 29.85, and that's pretty solid support. So if we happen to drift on lower, maybe get a false breakout here, back test of that trend line or something, this would be your next objective buy point. And those divergences would probably continue to extend. So there it is. That's why it's not an official trade idea right now. My confidence isn't super high, but we could probably get at least a little bounce here, and then worst case scenario go down a little bit more before we have a meaningful rally. Moving on, let's look at fixed income bonds. I am still very much like investment grade bonds. I need to specify investment grade, meaning I'm not crazy about junk bonds, treasury bonds, investment grade corporates. I know that's a counter trend trade. I know nobody's wanting anything to do with bonds. Everybody thinks rates are going to the moon now. My theory is that there's a negative feedback loop in the markets right now. The Fed is in a pickle here. Inflation starts heating up. They start raising rates or talk about, increasing their trajectory of rate hikes and quantitative tightening, QT. Then the stock market's going to throw a fit. Stock market goes down, consumer sentiment goes down. Then the outlook for the interest rates change. They start backing off their hawkish statements, and you're going to see rates come back down. Call it what you want. That's my theory. That's what I think is going to happen here. So I think at the very least, we probably have found a near-term floor. I mean, you can't argue that. I mean, in my opinion, I look at this chart of TLT. These are the long-term Treasury bonds, 20 to 30-year bonds. You cannot argue this is not a very significant support level. There it is. And again, we had positive divergence right here. We had negative divergence at this high that was pointed out. That led to this drop here. This is what I do, as a swing trader. I look for these divergent highs, divergent lows. We had a divergent low, a rally. We had a divergent high, we had a correction. Now we have a divergent low at support, a support level that's held all the way back to 2016 on every test of that level. And again, it may not play out. Bonds I know are boring, but the thing about bonds are that you can put a 2-3 time position on in your portfolio, because treasury bonds you're not going to wake up to a 5-10% or 20% gap down like you can on a biotech stock. They only move, percent or so a day, and they kick off interest. So even if we just bounce around. Let's say we trade in a sideways range between this. That was the last trade, T2 around 122 to 116 or so, and we trade that way for 6 months to a year. Well, you're getting paid to stay in this. I forget what the yield is offhand. It's not showing me. It usually populates the yield right here. But again, you get paid to wait, and it's part of asset allocation in your portfolio. It's a way to have your portfolio firing on all cylinders in case one of those cylinders stops working. The engine's going to keep running and get you where you need to go, versus trying to concentrate all your positions in, stocks or commodities or any one asset class. So there it is. Over time, these are the same targets as last time. These are the actual levels in white. These were the targets before 119.28, 122.06. Let's just see what happens here. But again, looks good for now. And then there's a couple more. There's IEF. Those are a little bit shorter term. Let me go down to my bond list. IEF. This is an active trade and has been for a while. I think we're probably a little underwater, but maybe not. It's been paying dividends, so the cost basis gets adjusted downwards. We might have had another dividend since I last updated this, but remember, if you're in a dividend-paying stock or ETF, even if the price goes nowhere and you sit there for a year, you're collecting, depends on the security, 3, 4, or 5% interest or dividends, and so you're having a positive return there. So the chart looks good. Is what I wanted to point out. Positive divergence. We're starting to move up. We need to take out this 101.75 level. That's a pretty significant and important resistance level, as well as that downtrend line. And I love when I see two resistance levels come in together. That way, if they're taken out, it's all the more powerful of a buy signal. And that would, most likely open the door for a move up to that first target and possibly some more of these. I may revise these targets. We'll see how things go, but as of now, I like that. And the other one I like right now is the corporate bond ETF as well, investment grade. These are investment grade corporate bonds. That means companies with, AAA down to double, triple B rated bonds. And you can see here, same story, divergent low. There's a trend line to take out. This is a very important level, 115.61. That was former support. If we regain that level, you can see all these reactions back here. This was an important support level for LQD. So if, and again, a big if, we can take out 115.61 with conviction, that will have laid the ground for a bear trap here, and that would be very bullish. A recovery of that former support, now resistance level, probably throw us back up here at about that 117.48 level. And again, these are bonds. You're not going to get rich quick on them. It's only a 2.5% move up to there. But if it takes several months to get there, it's kicking out a nice dividend yield. Again, I don't have it offhand here. You can look that up. I might have stated it in the past. On a somewhat related note, really a whole separate asset class in itself, or the REITs. Technically they're equities, but they're they march to their own drumbeat. Because REITs spin out a nice dividend. You can see here on Simon Property Group, which I'm looking at, SPG. I know the symbol's obscured a little bit there. It's about a 5% dividend yield. I mentioned this one as a trade idea down here within this falling wedge. Held off as an official trade idea because it was set to report earnings. Then it popped right after that. I probably should have just added on. I was waiting to see if we did get a pullback recently. I updated this in the trading room. So this one looks good. Positive divergent low. And where I'm going with this is kind of segues into what I was just talking about with bonds and my outlook for interest rates. These are REITs are rate sensitive assets because they pay a high dividend yield. They've been sold off and corrected down with the rising rates that we've had and the expectation for additional rate hikes in the future. So if the Fed doesn't have to turn course and say, oh, we're going to start cutting rates. All they have to do at this point is start backing off their hawkish statements, their planned trajectory of rates. If that trajectory, at least the implied trajectory of rates, starts to come down a little bit, in other words, where the Fed fund futures are priced, where investors think rates are going to go, you'll see these dividend paying stocks and sectors start to rally, and as well as bonds. And so this is, again, I'll point this out because there's probably going to be a pretty decent correlation between me being right on the call for a rally in bonds, along with a rally in these REITs. But I like this one. Broke out, had the initial, it was a big move up. It needed to correct. Came back right to this R1, which is actually S1 now. That means at the time when I first posted this chart, R1 meant first resistance level. We were down here somewhere. We took that out. Resistance once broken becomes support, so that should have been S1 at the point it was taken out right here. And look at that, we pulled right back to that S1. That level was posted way back when, and we've rallied. So that's, like I say, there's two times in trading that you want to go long. You want to go long on a break above resistance, which you had here, or on a pullback to support. And so you can see these are the additional targets. Again, this is an unofficial trade. Remember, I think it was Big Bad Wolf mentioned, and there's a ton of them out there, a ton of REITs, but KIM, and that's certainly a nice one. This is how I have the chart drawn, this little downtrend line, this little price channel breakout recently, divergent low, everything I like to see. We have a little resistance here around 1536, but I think we come up to this downtrend line at the very least. And again, this one's kicking out a nice yield, 7.65%. So come up there, probably a little reaction, maybe need to base for a little bit, but if we break out, we're probably headed all the way up here to 1778. So there's still plenty of meat left on the bone, for a longer term trade. I'm trying to measure it for you. I have to do this. Somewhere in the area of 15% or so just on capital appreciation if we get up to that 1778-ish level, and all the while it's kicking out a dividend yield of better than 7.5%. I'll just cover two more things and we'll move on. This video's gone long enough, but I wanted to kind of be not all inclusive. I haven't covered all the trade ideas. We don't have many shorts right now. Still just need to see a little bit more in the market, and I need to see some clean, objective setups. I don't want to fight the trend right now on the shorts. But Netflix has been a short forever and a day. Now we hit the first target, and I made mention at the time we were probably going to bounce. I believe I made mention there, and checked the time to cover, and we did. We bounced, but we put in an extension of the divergent high. So we had a divergent high when we shorted it back here. hit that first target, bounce, put in a second divergent high, remain below our stop, and we still are. Any new high at this point will be a divergent high. We're almost there. We're not far from it now. So what you need to watch if you're either short this one or wanting to get short are two things. Oh, mainly this. Watch a break of this trend line. We have a pretty well-defined uptrend line forming off the lows here when that first target was undercut slightly. And as you can see, any new high at this point will be a divergent high. It's going to be close. If they take a run at the highs, and they probably will if they pop it out, if the market holds up here, you're probably going to see Netflix run at and probably take out that previous high. They may clip our stops. I'm warning you right now. I think if they do, it'll reverse and go down. Um, so, uh, do what you want. I'm going to leave that stop as is for now, but that's what I'm looking at. This bearish rising wedge, negative divergence, almost certain to be another divergent high if we pop to new highs soon, and that's Netflix. Finally, just added GBTC the other day. It's sucking wind so far. I don't even know if we've taken out the stop yet. Let me see. I don't think I set a price alert on that one. I'll have to revisit the parameters of the trade, but there's support there about 1194. Let me see if I can show you the Bitcoin futures. Yeah, here it is. This is Bitcoin futures. I went long here on the pull, but the gap backfill. And so far, now here's what's happened. We certainly didn't bounce there. But however, this chart still looks constructive. We've taken another thrust down, but we still have some powerful divergences here in place on the 60-minute chart as we make a new low. So yes, this was a failed breakout. So what we can do is probably redraw this trend line now, like to make it look like something like this. So it depends who you are, how you trade. Here's our previous reaction lows back here. So this is all support. It's not a hard line support level. Would have to draw a support zone. I could give you two lines here. Let's do this horizontal line. I'd say that support zone runs from about right there down to the bottom to the lows. As long as those divergences remain intact, I do like the longer term outlook of this one, but right now, as you can see, it's coming under some selling pressure. So I'll have to revisit GBTC, see if that's still above the stop parameter, um, and then I'll put an update to that trade if we have been stopped out. We'll wrap it up here. That's a lot to cover, but those are the things I'm watching right now. And let's see what happens as I talk. The equity markets continue to build on today's gains, so watch those levels that I mentioned in that first video, and that might give us some clues to where we're headed in the U.S. equity markets in the coming days to weeks. This has been Randy Finney with Right Side of the Chart. Hope you enjoy.